before we discuss financial crises, it's important to discuss what financial systems do. First, they finance investment. Financial markets directly finance investment through stocks and bonds, while financial intermediaries indirectly finance investment. Second, financial systems help to share risk. Through mutual funds, idiosyncratic risk is reduced, though systematic risk is not. The financial system also helps deal with asymmetric information. Examples include adverse selection, which is hidden knowledge about attributes, and moral hazard, which is hidden knowledge about action. Finally, financial systems foster economic growth through microfinance.
The anatomy of a financial crisis starts with the asset price boom or bust. This is often a period of optimism that leads to large increases in prices, and this precedes a financial crisis. After this, there will be insolvencies in financial institutions. This is a period where liabilities are larger than assets, and certain banks cannot pay off their debts. There's then a falling confidence in the market, and this will then lead to a credit crunch where banks will refuse to lend out money to any and all willing customers. Also during this time, there could be a fire sale of assets where the banks try to offload their bad assets on the books instead of waiting for a price period where the prices are higher. Finally, there's the recession. The recession is where the financial crisis leads to an economic downturn and banks are unable to fulfill their lines of credit. This then leads to a vicious cycle of the financial crisis.
Once said, "Victory is 1,000 fathers, but defeat is an orphan." This famous quote explains that everyone is eager to take credit for success, but no one wants to accept the blame for failure. And this is very true in the financial crisis of 2008-2009. Many of the blame is put on the Federal Reserve. The nation's central bank kept interest rates low in the aftermath of the 2001 recession. This policy helped promote the recovery, but also encouraged households to borrow and buy housing. Another blame is put on home buyers. Many people were reckless in borrowing more than they could afford to repay. Mortgage brokers are also to blame. Many providers of home loans encouraged households to borrow excessively. Investment banks. Many of these financial institutions packaged bundles of risky mortgages into mortgage-backed securities and then sold them to buyers. And they were not fully aware of the risks they were taking on. Rating agencies. The agencies that evaluated the riskiness of debt instruments gave high ratings to various mortgage-backed securities that later turned out to be highly risky. Regulators. Regulators of banks and other financial institutions are supposed to ensure that these firms do not take undue risks. Government policymakers. For many years, political leaders have pursued policies to encourage home ownership. Such policies include the tax deductibility of mortgage interest and the establishment of Fannie Mae and Freddie Mac, the government-sponsored enterprises that promoted mortgage lending. In the event that a financial crisis does occur, there are three main responses. First is conventional monetary and fiscal policy. As we have seen, financial crises raise unemployment and lower income because they lead to a contraction in the aggregate demand for goods and services. Policymakers can mitigate these effects by using the tools of monetary and fiscal policy to expand aggregate demand. The central bank can increase the money supply and lower interest rates. The government can increase government spending and cut taxes. That is, a financial crisis can be seen as a shock to the aggregate demand curve, which can to some degree be offset by appropriate monetary and fiscal policy. Second is the lender of last resort. This is when the public starts to lose confidence in a bank and they withdraw their deposits. In a system of fractional reserve banking, large and sudden withdrawals can be a problem. Even if the bank is solvent, meaning that the value of its assets exceeds the value of its liabilities, it may have trouble satisfying all of its depositors' requests. Many of the bank's assets are illiquid, that is, they cannot be easily sold and turned into cash. A business loan to a local restaurant, a car loan to a local family, and a student loan to a roommate, for example, may be value assets to the bank, but they cannot be easily used to satisfy depositors who are demanding their money back immediately. A situation in which a solvent bank has insufficient funds to satisfy its depositors' withdrawal is called a liquidity crisis. Third is an injection of government funds. This is the most direct action of this sort and is a giveaway of public funds to those who have experienced losses. Deposit insurance is one example. Through the FDIC, the federal government promises to make up for losses that a depositor experiences when a bank becomes insolvent. In 2008, the FDIC increased the maximum deposit it would cover from $100,000 to $250,000 to reassure bank depositors that their funds were safe. In addition to the question of how policymakers should respond when facing a financial crisis, there's another key policy debate. How should policymakers prevent future financial crises? Unfortunately, there's no easy answer, but here are 5 areas where policymakers have been considering their options and in some cases revising their policies. First are shadow banks, where higher capital requirements would be made and there would be lower leverage rates. Second is restricting size. Get away from the idea that banks or insurance agencies are too big to fail. Third, reduce excessive risk taking. Volcker rule. Fourth, overseeing fragmented regulation. Fifth, macroprudential regulation, top-down regulation, which is a different idea from microprudential regulation.